afternoon. Can everybody hear me? Okay, very good. Thank you all for coming out this afternoon. Want to introduce my very good friend Tad Melton from Ziegler. And the first thing that I need to tell you is Tad is not selling anything. Okay. So Tad, despite the fact that he looks like he's 18 years old, has been in the industry for many years and is really an expert on the long-term care industry. In addition to that, he has been our either bond salesman or financial representative on all of our refinancing for the past 15 years. And so Tad knows the industry, and he also knows Falcons Landing. In fact, Tad likes Falcons Landing so much that when he was with BB&T and they lost our business, he moved to Ziegler just so he could keep working with Falcons Landing. So without
Absolutely
further ado,
true. Absolutely true. Thanks, Hardy. Can everybody hear me? Okay. I'm trying to get, do I need to move that away from my, I'm happy to hold a mic. That's better.
I think it's better now. Say something else.
Is that any better right there? Or is it still a little muffled? Yeah. Well, I'll go ahead, and I'm happy to switch if there's something. My name is Tad Melton. Can everybody hear me if I take it? It's still a little muffled, isn't it?
It's kind of
Tell you
echoes.
Yeah?
It's okay today.
Okay. All right. If it's, I can hear. My name is Tad Melton, and I live in Richmond, Virginia. I'm an investment banker, and I work with Ziegler, as Hardy mentioned. And Ziegler is the leading investment banking firm serving the not-for-profit senior living industry. And I have had the privilege of working with Falcons Landing and Hardy for a long time. And in addition to financing activities, we also have a very extensive strategic advisory group. And late last year, Barb invited me to come and visit with the board in early January. And she said she just wanted me to give an update on the overall senior living industry and trends that were occurring at organizations like Falcons Landing from a strategic as well as financial standpoint. And we did that in early January. I think it was very well received, and immediately folks said, well, why don't you come back and do this for anybody else who wants to hear it? And so that's our goal today, is really for me just to share with you some observations that we're making about the nature of senior living in America right now and trends with peer organizations to Falcons Landing. And I've broadly broke it, and I'm going to try to speak for maybe about 20, 25 minutes, and I'm happy to take your questions thereafter. So I've broken this down into 4 sections. The first is I'm going to tell you a little bit about Ziegler, not, as Hardy says, not because we're here to sell anything, but I'm going to make a number of observations, and I think it's important for you to understand kind of how we're organized and why we're in a position to make some of those observations. We'll talk about the industry, key trends affecting the industry, and then take any of your questions. So Ziegler is a traditional investment banking firm headquartered in Chicago. Our core business is bond underwriting for not-for-profit senior living communities. And so that often takes the form of a traditional tax-exempt bond issue that's sold to investors, or often we're placing debt with institutions such as banks on your behalf, not lending our own money, but more or less as a strategic advisor and broker to broker those transactions. In addition to that core function of working with the residential facilities, we also have private equity funds that invest in technology companies that are involved in senior living. We have real estate venture funds that will participate in the equity related to for-profit rental facilities, and a variety of bond sales and trading. So we're very active in anything that really touches the financial affairs of an organization like this. And as far as our bond underwriting, we are and have been the leader in our industry for going on 30 years now. The numbers here are really not important, but each of these is over 2019, 15 to 19, all the way back to 2000. This purple bar would represent our activity in our sector, and these would be our top 10, our next 9 closest competitors in the top 10. And the point is that we do a significant amount of this business across the country, about 45 to 50% of the activity in the entire industry each year. which is usually about $3 to $4 billion of financings. It's usually somewhere in the neighborhood of 75 or 80 financings a year. So we are very actively working on a day-to-day basis. In any given year, it might be with y'all, but with a large variety of Falcons Landing's peers on their growth activities. And in Virginia in particular, because I live in Richmond and coordinate our group's activities from southern Maryland and Pennsylvania down to Georgia, we have a significant number of your peers that we work with, notably Ingleside at King Farm in D.C., Goodwin House, and you can see some of these Westminster Canterbury communities around the state. And I would say in any given year, we're probably transacting 10 or 15 transactions in this Mid-Atlantic section. One of the very unique things, though, about our organization and how we've invested our resources is in the late 1990s, we created a research department, and its job is not to create research recommendations like a traditional brokerage firm, buy this stock, sell that stock. But we have a group of about 6 individuals whose job is to follow the strategic opportunities and trends that are available to our clients, as well as some of the operating challenges. And the goal is to be able to share that knowledge with all of our clients, hopefully making them stronger along the way, but better enabling me and my peers to be able to come out and share observations and give strategic advice. Each year we have a number of conferences. Last year we had 13 conferences. Often Hardy or Barb or Donna from Hardy's office will attend. Our flagship conference, I think Jim's been to some of these, each fall attracts somewhere around 600 to 800 people, usually CEOs, CFOs, and board members of organizations. So we put a lot of emphasis into understanding at a very detailed level what's going on out there, not just in the financial markets, but in the operations of our clients. So it's with that in mind that I'm able to draw on a lot of information and experience that we have to be able to bring to you some of these things today. And so what I thought I would do to start off with is just talk a little bit about how the CCRC or Life Plan Community industry is structured right now, and notably how Falcons Landing fits into that as a member of that industry. So there are 2 different labels that we often apply to life plan communities. And one is what we would call this historical business model, which is the evolved versus the purpose-built. And we think of the growth of our industry really accelerating in the 80s and 90s. Falcons Landing was opened in the late 90s. So most campuses like this that were built from, say, 1980, 85 and on would be what we call this purpose-built model, where you have more independent living, and as people flow through the continuum, you've sized the number of beds and units through your continuum to take care of the people that started in independent living. You kind of funnel through the continuum. Versus a lot of facilities that go back to the 70s, 50s, in some places that you see places that are 100 years old, are more of what we would call this historic business model, and they often started as a nursing home, home for the widows and orphans, and terrible names like that. That might have county-owned nursing homes, might have 100, 150, 200 nursing beds. And as the industry evolved, and folks said we want to diversify on these campuses and turn them more into a life plan community, they added independent living and assistant. And they're 2 very different types of models to manage, and the economics of the 2 are very different. Traditionally, independent living is the highest margin of the businesses on a campus like this. And as you move through the continuum, it becomes less profitable to almost, some of these sections you operate at a loss. And then when you blend it together, you get the financial stability of an organization. And so Falcons Landing is very much a very deliberately designed and created life plan community as we think about them in the industry. Now, this is a very busy table, but it's actually, I think, really interesting. And I'll guide you through it. On the left here are what I would characterize as the different options in the senior care spectrum, if you will. These are hard to see that are gray, but most of these are what I would say are residential options. So independent living, which might be like a 55-plus apartment complex or some Del Webb community in the south. Freestanding assisted living, and as you move through these, you pick up acuity and aging and so forth all the way up to hospice, affordable housing. And then a few of these are non-residential, which would be adult daycare, hospice, and home health. So right here you can see the number of communities or properties that operate in each of those. And so as a life plan community, Falcons Landing is one of 1,951 campuses like this in America. They're owned by 1,146 organizations. So what's that mean? It means many of these might have 2 campuses. Goodwin House, for example, in Alexandria has 2 towers over in Alexandria, so they have 2 campuses. And they're a total of about 600,000 units. What you see here, though, on the right is the percentage of these facilities that are owned by not-for-profit organizations. And what's interesting is only when you have a life plan community model, like Falcons Landing, is an adult daycare, I guess, is at 51%, but do you have a majority of the field actually owned by not-for-profits? And so that's an interesting observation. Most of these communities down here are owned by private businesses, whether they're large national chains or small local folks. There are a number of reasons for that. One is this is a very complex type of organization to manage and run, because you essentially have 3 or 4 or 5 of these different types of businesses in one organization or on one campus. They often take a significant amount of land. So if you're in a very densely populated area, it's hard to control land. They also typically take anywhere from 5 to 9 years to open from the moment that you've conceived the idea to build one of these campuses. And Hardy can relate to some of that. He was around in the 90s here when Falcons Landing was built. They're very challenging. And the typical cycle to conceive of the idea, design the facility, go out and pre-market it, construct it, fill it up, oftentimes is an entire business cycle. And so it just doesn't lend itself traditionally to a lot of the development-oriented strategies. So said differently, there are significant barriers to entry for competitors to an institution like this. And the not-for-profits, due to the fact that they require a lower profit margin and a perpetual ownership, typically fill this sector. Where are they? This is a map of the United States, of course, with the number of life plan communities in each state. And here in Virginia, we have 59. This would be defined by an institution or campus that has 3 levels of care. So it might be independent, assisted, and memory support. Might also include nursing. But the definition to make this mix is you have to have 3 levels of residential senior housing on one campus. And as you might imagine, you can see it's kind of like looking at the map on a presidential election night. Most of the places are where, this is a scale business. And so to earn the economies of scale from your operations, you need to be able to grow it over time. And so it's easier to grow a larger business in a more densely populated area, hence where you find most of these institutions. This is also a very communal concept. It's pretty well documented through consumer research that the #1 predictor of resident satisfaction at a life plan community is that person's willingness to recommend moving in to one of their friends. And so you'll often see, whether it's, and I'll show you some stats in a minute, whether it's a religiously affiliated sponsor group or military or some type of fraternal, most campuses like this have some core tie to some type of social or communal group. This is, I'll walk you, this is metro designation by profit status, because as I mentioned, 77% of the life plan communities are not for profit. The balance are for profit. Where are they? Well, what we find is that we find more operating efficiencies through larger scale and through multiple locations. And so for the profit-seeking owner, which would be the for-profits, the best place to locate your property is in major metro areas where there is a lot of population. So what you can see, it's not a lot, but the top half of the for-profits are located in very large metro, large, and medium. Whereas you can see the not-for-profits fare pretty well in the metro areas, but they tend to be a greater percentage of the market share in medium to lower metro areas, where it's harder to earn the kind of scale that comes with a business like this. And this just breaks out, I thought this was interesting in numbers, because you see the DC area here, the top 10 metropolitan areas in the country for the number of life plan communities. It's actually interesting. I mean, when you think about many of these places and think about how big DC is, it seems that it's somewhat underserved, actually, from a number of campuses, which is probably a factor of how hard it is, particularly at this stage of where we are, to get real estate to build something like this. I mean, I didn't work on the original financing of this organization in the 90s, but have known a lot of the folks who did and knew many of the original board members here. This was farmland in the late 1990s, and to get that type of land here today, you have to go out pretty far as well. There's virtually no new communities like this being built in the district, and they're virtually all full. Those Ingleside campuses are virtually all full. So of the, you'll recall I said this a minute ago, there are about 1,950 communities, 1,150 or so are singles, and the others are part of a system. This just breaks out for you kind of the breakout between which campuses are owned by a multi-facility system that has more than one location, and which one is single site. So you can see within the for-profit sector tends to have more systems. The not-for-profit sector tends to have more single sites, and so y'all would certainly fall right into this part of the curve. This pie chart shows you of the not-for-profit communities, how are they sponsored or what were they affiliated with. So 58.5% are affiliated with a faith-based organization. What you'll find, interestingly, so obviously with our market activity, we work with a lot of those folks. What's really interesting, unlike a military-sponsored community that has certain qualifications for admission based on your relationship with the military, most of these faith-based organizations, whether it's the Lutherans or the Episcopalians or whatever, actually derive a very small percentage of their residents in this day and age from their sponsoring faith. Usually it's about 20 to 25% of the residents at a particular life plan community will actually hail from that sponsoring faith. The only exception would be the Jewish communities. They are virtually 100% Jewish, which has a lot to do, I think, with the dietary plans and programs and so forth. But as you can see, they're about 1% as of the time of this, so about 18 or 19, I guess, of that cohort would be military related. And Hardy asked me if I would just throw this in here. This is a list of many of those military communities. We have Falcons Landing right here. Vincent Hall is a great community. It's in McLean. I've worked with them over the years some as well. Ginger Cove over in Maryland. I will tell you that it's increasingly challenging for many of these organizations to recruit folks to move. What we've found is that the typical life plan community, forget the sponsoring affiliation, needs to derive about 75% of its residents from a 15 or 20 mile radius. And that radius will get tighter when you're in a major urban area like this. Falcons Landing, Vincent Hall, they obviously benefit very much from the U.S. government and military presence in this greater area. But what we found is that many of these others around the country that are in what I would kind of call satellite locations, in so much as they're not close to a built-in kind of government or military area, have started to experience some declines in their occupancy, and a few of them have actually gone and opened their doors just to general civilians or even sold themselves to a for-profit company. So I would predict that over time we might see best case status quo, maybe even a few less military-only communities. So one key difference between for-profits and non-for-profits is that almost all for-profit life plan communities have virtually no buy-in fee or no entrance fee and only a monthly rental fee, whereas virtually all nonprofits, 58%, charge an entrance fee, another 10% or so. So almost 70% have either an entrance fee or a blend, versus in the for-profit world, it's almost all rental. And we hear a lot with what we do about the fact that consumers have a preference for rental versus independent living, and what will versus entrance fees. What will the future hold? Well, I'll say this, that the rental fees that most of those for-profits charge are typically much higher than what you would pay. So your entrance fee is kind of a buy down, if you will, the future cost of a lot of those services. But it is largely related not to consumer preferences, but to the initial capitalization of the businesses. Not-for-profits have the ability to get virtually 100% financing, so very little down payment, almost none. And that's what the bond market will make available to not-for-profits. And so you'll often see not-for-profit utilize an interest fee contract and then take a substantial portion of those initial entrance fees that come in and use that to pay down debt. And that kind of becomes the quasi-initial down payment or capitalization of the community. And then if a community is well run, and yours is very well run, over time those entrance fees are mostly used for capital to maintain the quality of living in the organization. Whereas in the for-profits, their only capital is going to be bank financing or real estate investment trusts. And they're always going to have to put 25+% down, just like you might have to buy a home or something like that. And so they tend to charge that model differently because they can raise equity for that. A nonprofit can't raise equity. So what's the average size of a campus like this, and how do y'all fit into this? This pie chart shows the percentage of the 1,951 communities that are between 100 and 200 units, 200 to 300, 300 to 4. And you can see that about 54% of the industry is lower than 300 units. What I'll tell you, today, y'all sit at 435 units, and that's growing with some of the work that you're doing on the campus. Why is that important? Because as I said earlier, this is a fixed asset business, and your ability to grow over time and create economies of scale is key to optimizing the operating performance of an organization like this. And you typically don't optimize the financial performance of an organization like this until you can get to about 325, 350 total units. And you have more, from just a mass standpoint, you have more occupants, more residents to spread the fixed cost of a room like this or certain operating expenses over. And so at 405, I think we said you'd be right up here already in the top tier of the industry in terms of your size, which is a real attribute to how y'all have grown over the years. And I'll say this to credit Hardy in particular, with the exception of the debt that was incurred for these most recent projects, Falcons Landing has never borrowed any debt since its initial borrowing to fund projects. They've all been funded through internally generated capital, which is a very strong and very unusual, frankly, set of facts. A lot of people don't have that to say. So to be able to grow to this level of scale with the financial management you had is quite remarkable. And you can see right here, as I'm about to transition to the next slide, the average campus has about 150 what we call independent living, so that'd be apartments or cottages, as y'all know. 52 assisted living, 25 memory support, and 91 skilled. So the average community, going back to that whole pyramid, the average community is probably, there are more business models that have evolved from larger traditional nursing homes than there are purpose-built communities. And we're seeing, if you think about some of the projects that are going on here right now, memory support is an area that's getting a lot of capital. They tend to be smaller as a percentage of the units on the campus, but the memory support units are virtually full with all of our clients. That's more and more of a need in our society. And so kind of bringing it to kind of try to drill down into your circumstances and in with your profile as it relates to all this. You were open in the late 1990s and have been continuously expanding and reinvesting And while originally available to just retired military officers and spouses, you're largely still within the military family, if you will, but broadened that out a little bit over the years. Your organization has consistently been very strong from an occupancy standpoint, and it's probably due to the affiliation with your core group as it compares to the rest of the industry. Occupancy overall was off a little bit during the Great Recession, but y'all's decline was much less than the peer group and rebounded much faster. So very strong occupancy traditionally. Hardy asked if I could just make that the only the statement on this slide. It's a very strong financial management. But it's true, as I mentioned earlier, y'all have had a real discipline around reinvesting capital in the things that matter to the folks that live here, and that's a key attribute. This is where we've been involved a lot of the way. We've constantly taken that debt down from both what y'all have paid down to interest rates in the 6%, 7%, 8% in the late 90s, down to now in the 2%. And so as y'all have evolved and grown as an organization, the market has rewarded you. Interest rates have gone down, but with a lower and lower cost of capital versus the peer group, such today that you're very well positioned from a financial standpoint. One thing that's interesting, it's worth pointing out though, is that your independent living unit inventory has declined from 319 in the late 1990s to about 304 right now. And that's just probably due to combining some smaller units along the way. But that is a long time to go without some significant growth in unit count, just as it relates to most other participants in the industry. And so the current projects that y'all are working on are really timely, very strategically in tune with what we're seeing out in the industry, and really should be to the benefit of everyone here, because they're going to further add to the economies of scale and the capital generating capacity of y'all's organization and the ability for management to continue to reinvest in the current plant. It's interesting when you stop and think about a not-for-profit that doesn't have any equity ownership. And what we ask as members of society is that the people that manage these organizations and the boards keep them at a top tier kind of Class A level in perpetuity. Whereas most office buildings or apartment buildings or things like that, they'll be traded over time to different types of owners and they'll take advantage of market cycles and not make a lot of the types of investments that you have to make from time to time to keep something in top condition. So it's not uncommon in our industry, in our experience, to see people every 10, 15 years have to invest significant sums in capital that don't have much of a return. But in order to keep these types of buildings and the programs and the environment at that Class A level, it takes a really long-term time horizon and a significant emphasis on how you spend that capital. And obviously, y'all have done great here. So speaking of strategy and strategic and some of your current projects, I thought we'd slip next into kind of what's going on out in the industry. What are some of the trends we're seeing operationally, strategically, both with your peer group as well as the country overall. I'll touch on all of these in a little bit more detail as I move through the next few slides, but most organizations are currently experiencing very strong occupancy. The demographics of the United States are really starting to age, and the demand for this type of residential living and this type of programmatic experience is very high. So that's bolstering cash flow, bolstering entrance fee revenues, and it's giving management teams and boards the confidence to go out there and make larger capital investments and grow their businesses. At the same time, though, we're seeing consumer needs kind of evolving. The typical campus like this needs to be repositioned from a curb appeal and programming standpoint about every 10, 12, 14 years. That's about the turn of a generation. If you think about somebody who would be 90 today might have different consumer expectations than a baby boomer who's 45 or 50. For better or worse, they're very different. And so when you're managing a building like this over time that you need to continue to keep attractive, you need to continue to evolve. That's a big, particularly with the baby boomers about to be at our doors, that's very important. Income statements for businesses like this, while the cash flow is very strong from entrance fees, are being negatively impacted by how tight the labor market is. In particular, the type of labor that is needed to run a business like this. And it's not, nursing has long been a challenge, but the back of house hospitality type of jobs that go into a hotel or a business like this, food, services, and those types of things, those folks are in high demand in today's world. We're seeing significant turnover, a generational turnover in the executive suites. I'll tell you more about that in a second, but there's over half of the executives in the industry will retire in the next 5 to 10 years. There's an active merger acquisition market going on, and we'll talk more about that. There's capital flooding into the sector right here. And we're also seeing folks say, all right, well, we do want to continue to grow, but we don't want to grow our campus any longer. We'd like to find some business lines to take out into the broader community and do business with people who find value in what we bring to the table, but just choose to reside at home. So that's a significant trend as well. And this, I never get these things right that zip through. So there. So this is a I didn't get this one updated from our earlier presentation, so this is still 2019, but you'll see this is the demographics of the United States. This was at the end of 2019. Here we are today in 2020. The population of people that are 75 plus will double between now and 2040. The trade association that works with this sector is called Leading Age, and there's a Leading Age National, and there's a chapter in each state. Leading Age North Carolina is somebody that we work with a lot, and a few years ago they did an economic impact study in North Carolina. It was part of their lobbying efforts, but they wanted to determine the economic impact of their CCRCs, or Life Plan Communities, rather. Part of what they figured out, though, and this was about 5 years ago, is that in North Carolina, between 2015 and 2025, just to maintain the same level of market share with seniors, so not every 75 plus senior is going to move into something like this. So just to maintain the same level of share of seniors, they would have to double the number of residential communities like this in North Carolina. So in addition to the strong economic condition of the country right now, strong housing market, there's strong demand to live at these types of places because there are more and more seniors who need this care. This is going to be a real opportunity for the participants in this field in the next 5, 10, 20 years. It's going to be a real challenge for our country. Typically, in any given market, the number of people who are both age qualified and income qualified. So let's say that the average age of entry to a place like this is 78. So everybody who's 78 or older and has the financial capacity, so they're income qualified to move into this. Of that universe of folks, only 10% of them will actually decide to make a move. So it's a very small percentage of our society here in the United States that can afford this type of living option, and let alone want to be here. And so we're going to have a lot of folks who are going to need, a dignified place to age, let alone the opportunity to do well at a Life Plan Community. So great opportunity. Going to be a challenge. I mentioned occupancy is high. Not-for-profit Life Plan Communities are running at about 92.5% full when you combine all the different residential options along the way, assisted nursing. That's about 5% greater than the for-profits. This relationship almost always holds true. It broadened out during the recession, so not-for-profits are generally more attractive to your peer group when they're assessing their options, usually because of that communal nature that I mentioned, as well as the reinvestment. If you were at a for-profit Life Plan Community, this room would probably be half as big, because they would be calculating the return per square foot on every inch of the building. So the not-for-profits tend to invest in a lot more of the amenities and programs. What I'll tell you, that's 92.5 overall. This slide shows you, if you were to break out some of these different types, that first slide where I showed you the percentage ownership of not-for-profits and the different residential alternatives, Here's some just independent only, so they just have apartments or cottages, but no other, assisted care or memory. So here's independent living, assisted, memory care, nursing. Those communities only offer that versus a life plan community that has it all. So that's that 92.5%. So this type of style of opportunity is more attractive to folks. What I'll tell you is that most of our clients, when you break this out for on your campus, independent, assisted, memory, skilled, in the not-for-profit sector are going to be 95 to 98% full right now. Usually that difference is some units that have been turned over and are being refurbished. In our sector, if you're not virtually full right now, you're probably in a locality that is experiencing some real challenges with its economy. So Southwest Virginia, Western North Carolina, and a lot of those communities that have been affected by the tobacco communities, furniture, textiles. It's really tough. Danville, Virginia, Martinsville, Virginia, Hickory, North Carolina. If you're in an area that's growing, you're pretty full. Or if you're not full, you haven't reinvested in your campus. And over time, folks will stop coming if the hospitality nature of what this place is supposed to include isn't there. So this is a depiction of financings that Ziegler facilitated, so our core investment banking practice over the last 5 years, how the money was used. So of the financings that we're putting together for Falcons Landing and your peer group, how are people using the money? Where are they investing? And this adds up to more than 100 because oftentimes the financing will be for multiple projects. But about 86% of the financings that we have worked on include some additional independent living. Many of those also have included memory care. And in fact, the one that we closed with y'all last year included money to invest in both of those areas. We've seen a significant number of skilled nursing construction projects in recent years, almost all of which were a renovation or what we would call repositioning of the skilled nursing area of a campus. It used to be in the 90s, 80s, a very institutional model was in vogue. So you had a nurse's stand in the middle and maybe 4 wings, and it was just very Spartan. Most folks today have gone to what we would call a more resident-directed, home-like feeling. It's a lot more dignified, and there's proven outcomes that it's a better way to age. And so that's a tough project, though, because typically when an established organization is reinvesting in its nursing and not adding any new beds, it's making that investment, which oftentimes is $30, $40 million, and really not generating any new revenue. And so that's a great example of the type of thing that a for-profit owner, if he or she knew that she needed to make that investment, they'd probably sell and let the next owner figure out strategically where they were behind. But as a not-for-profit, every so many 10, 20 years, we need to make those types of investments. And so that's been a significant portion of our financing activity. And these are some shots of a very nice life plan community in Charleston, South Carolina, called Bishop Gadsden. I just put some pictures in here. What are some cool things that other people are doing? And they're all the same things y'all are doing. In recent years, they've reinvested in their dining, creating more options that are less formal and more lively, so that folks have an opportunity to dine in other areas. It used to be 20 years ago. I don't even remember this. I've been doing this 23 years. All the dining rooms are full, and the men would wear coat and ties, and it was a very formal affair. And now when you walk through many of these types of campuses, at dinner time that might be the case. Maybe no tie anymore, maybe a blazer. At lunchtime, nobody's doing that. And so a huge trend in the industry has been towards more dining. And y'all were ahead of the curve on that with respect to your different venues. We're also seeing, particularly for these campuses like yourself that were built in the 80s and 90s, that are largely built out or nearly landlocked and want to grow but have very little room to grow. What we kind of call this hybrid home model, small apartment building concept, if you will, is one of the most popular strategic investments in our sector as well, because it allows you to get a little bit more density. Maybe you can build one of these where there were 2 or 3 cottages formerly, so you replace 2 or 3 cottages with a small building that could have 9 or 12 apartments. And usually these apartments have as much, if not more, square footage than many of your cottages, with these large, in this case, large windows. Because they're small, you often have corner units with a lot of light. And so it's a very desirable living experience, but it also financially enables the organization to get some more scale and add some more units. And so that's a very popular investment as well that a lot of our clients, I mean, well over probably half of them have or are considering that. And so that's obviously one of the components of y'all's current expansion activities, which makes, kind of your strategic trends very much in line with kind of the best in class in the industry. A few other things. I mentioned workforce. Workforce is tough. Over the last 2 or 3 years, the stocks of the for-profit assisted living in skilled nursing companies are down anywhere from 40 to 70%. And that's despite the fact that they're at reasonably decent levels of occupancy. And the reason that they're down is because their operating expenses are going up as they fight for talent, for employees, because the overall economy is so strong that the competition for people to help, housekeeping, dining is tough. What we're also finding is a lot of the healthcare workers are leaving the industry. Last year, I saw this recently, I couldn't believe it, 75% of certified nurses assistants who left their job left the industry. And it's, I've noticed in the newspaper, and this is purely anecdotal, but there have been, not of that magnitude, but similar trends with teachers, police officers, and a lot of the things that are so important for our society that aren't financially remunerative. And a lot of these CNAs, that's a very difficult job, very labor intensive, very stressful emotionally at times, can make as much money at working at Target in today's economy, and they can have predictable hours. And so it's a real challenge. As a not-for-profit, we can absorb some of those income statement things because it doesn't really, if we're not valuing our company or trading it. But staffing is a significant challenge across the industry. I mentioned CEO turnover. We do this, survey is really the best way to describe it. It's almost like a blog or something. But about once a month or every 2 months during the year, we send out a survey to the CFOs in the industry, and Hardy participates in this. And we ask, what are you doing in this area? What are you seeing in that area? Respond to the survey. And one of the things we ask every year is, how many years until your CEO and CFO plan to retire? And you can see that this shows the results of this survey in 2018, 2015, and 2013, every few years. And so in 2018, 32% of the respondents said their CEO would retire in the next 5 years. 70, if you just add these two together, 72, almost 73% of the CEOs in this not-for-profit life plan community industry will be retiring in the next 10 years. And the numbers are pretty much the same with CFOs. So that is a significant changing of the guard that's going to occur. It's very, it's going to be very important. It's kind of asking a lot of these volunteer not-for-profit boards to make very important decisions about who the next generation of leaders are going to be. And so, as Barb and Hardy assured me before I came up that they planned on working for at least another 25 or 30 years. So they're not in here, but this is a real, this is going to be a change in our industry. And so it's something of a challenge, but also probably something of an opportunity. I mentioned that we're starting to see merger and what we would call affiliation activity. If you think about the fact that there's no financial windfall for the board or management or the residents to sell an organization like this, we're starting to see other not-for-profits decide that they can get together and produce better outcomes. And we'll see how that plays out over time. I will tell you that kind of the classic corporate finance, MBA-style consolidation wave that occurs in most industries is starting to take a very fragmented senior living industry and consolidate it. In the not-for-profit sector, what we're seeing is some folks might say, all right, well, I'm in a declining local economy, or I'm built out from a campus standpoint and I can't continue to grow and get more scale. How do maybe I could merge with my neighbor down the street who shares a core not-for-profit mission, and we can wring out more costs and economies by being together and deliver ever better outcomes for our folks. So I think that will be a continued trend in coming years. What I'll also say, though, is that our single-site clients are better positioned and y'all would be at the top of that, better position than they ever have been from a strategic and capital standpoint. And so this shouldn't affect y'all unless you ever wanted it to, but we are seeing more and more folks decide just to get together and pool resources. What are some of the reasons that folks do that? Complexities of healthcare. If you're at a campus that has 150 or 200 skilled nursing beds, and if you have that many, you're probably providing a lot of Medicaid care to folks in the local community, which is very difficult. Most folks lose money on Medicaid and supplement that with some of their Medicare business or private pay. Many of those folks that are in these large Medicaid organizations are driving that merger activity, to be completely candid with you. Very little private pay life care community. Some organizations are saying, hey, we're losing our whole management team over the next few years to retirement. We haven't done a great job building bench strength. We want to merge with somebody who brings that to the table. That's an interesting one for me. I mean, I think that there is a significant pool of talent out there to come in and lead. And then we see it's when, a lot of times it's when the board is just kind of tired and lost its strategic interest in the organization. I have a friend who has made a substantial amount of money buying bonds of defaulted organizations, some retirement communities, but a lot of different other types of organizations. At say 10% of what they were worth, and then he'll sell it later for 50 or 60% of what it was originally worth. And I asked him one time, I said, have you ever learned is there one common thing in all of those defaults that should have been seen earlier? And he said, what I've learned over time is you can have a higher education, hospital, retirement community. It's almost always a bad board. So he said, the thing that is common, and you have a very strong board, but is when that board is not in tune, supportive of management, pushing everybody, that can be a challenge. So that's what's driving a lot of that merger activity, and it's obvious that y'all don't have a lot to gain from any of those areas. Let me zip through a few more of these things and then I'll finish up, but this is a for-profit development activity. I can assure you that at every private equity fund and every real estate developer, they've seen that same chart with all those baby boomers coming. And it's not hard to sit there for a modest subscription fee and try to figure out where all the existing retirement communities are, how they're located, where nearby land is. And there is a huge amount of capital flowing into our sector. This red is for-profit assisted living growth. So you can see going into the recession, there was a significant amount, this is units of inventory under construction, significant growth curve in for-profit standalone assisted living. Think of a 60 to 80 unit AL in or around a shopping district or something like that. The average age of somebody moving into that is 85 or 86 years old. So that's somebody who stayed at home, needs some assistance. Look at this. This is what really kind of should be noticed by a lot of the folks in the life plan community industry. For-profit senior living independent housing, 55 plus apartment buildings with services, nice new units is on a tear. And there are very low barriers to entry here. And there's a lot of growth, a lot of new competitors coming in. But what's interesting in the not-for-profit world, we've had virtually no net growth. So while the for-profits are growing, they're largely absorbing so far the growing demographic demands of the industry. So that will be a competitive factor for organizations like this in the future. And it's these new buildings are beautiful and furnished well and have nice units, and so it's ever more important in the management of a campus like this to keep it absolutely at the cutting edge of being well positioned, which takes that ability to generate that internal capital, and as I mentioned, you all have done so well here. This just shows you right here that I said we were about 92.5% in the not-for-profit world. The for-profit world is about 85.8%. Kind of reinforces that 5% gap I showed earlier. We are seeing a lot of folks focus on the home care, going out and providing services like this in the community. But what I'll tell you is that the amount of time that we've seen management teams spend on trying to understand at-home markets and go out and do it versus the financial return, it's been very disproportionate. It's really not been a nut that a lot of folks have cracked. We've seen a lot of folks do really well taking some of these kind of at-home services into the apartments and cottages on campus and do that in a high-quality way. It's a very different business model that not many of our clients have done a great job getting their arms around and scaling. One of the biggest areas of opportunity, as I mentioned earlier, is going to be in what we call the middle income group. And that's going to be somebody who would not qualify for what we call affordable housing, which is probably like $30,000 a year or less of income to spend, versus having the ability to pay an entrance fee of the type you do here and move in here. And so the majority of the population of the baby boomers, and in particular the 75-plus crowd, is going to fall into that $30,000 to $60,000 a year, if you will, income demographic, with maybe savings of $50,000 to $100,000, including home equity. As a society, that's where a significant opportunity exists for us to try to fill that gap, but it's very challenging to be able to get the scale that you need at that and the volume at that lower price point and make that work. It requires quite a bit larger down payment or equity contribution. And so we have a lot of our clients who are studying that and desiring maybe to build a satellite campus that's an extension of their mission, but perhaps at a different price point. And so I think that while not for everyone, we're going to see a significant number of second locations in the coming years with folks who desire to spread their mission to some other part of the local community. And then as I come to the end here, technology is going to be a significant factor in moving forward. I will tell you, to date, technology has having Wi-Fi and ability to communicate is not a nice to have anymore, it's a have to have. People expect it. And what we're learning is that a lot of technology options are affecting quality of care in the skilled nursing and in terms of care management and monitoring. We've yet to see significant, how shall I say, structural changes from technology as a result to the independent and more mobile folks. But as we you think about, it sounds kind of corny to say, but Amazon's Alexa is going to change how people communicate and get services. Uber and Lyft, we're seeing folks give second thoughts to how many parking spaces they build on an urban campus. Underground parking is usually one of the most expensive things in one of these projects. It could be $10 or $20 million. And some folks in Atlanta, there's a community I work with in the Buckhead area, and they had a very lengthy discussion about how much parking to build, how to invest that capital based on trends around driverless cars and things like that. So at this point, it's exciting to think about how technology is going to change things in years to come, but it's not a significant change agent, if you will, in how folks are experiencing today. And this just shows the percentage of capital budgets devoted to technology. This would be through one of those CFO surveys. And so you can see that capital budget devoted to technology hadn't really changed in recent years, nor as a percentage of the operating budget. And so it's a very small percentage of how we're spending money now, but likely to be a significant impact going forward. And then I'll end with this. I thought this was great. I shared this when I was here last month, but I saw this in the Wall Street Journal last year. And so this was an article on that the risk of dying within 5 years of retiring. And so this would be men not working. Their risk of dying, let's just call that within 5 years, was 7%. Versus if they were working, it was about 4%. So it was several percentage points higher. And the same with women, and so, which kind of makes a lot of sense, because one area where there is a lot of emerging thought leadership and discussion is around the value of socialization and friendships and community in how you age, and that isolation as you age can be very detrimental to your physical as well as mental capacity. And it seems as if some of this data is starting to bear that out. What's also interesting is that the risk of being prescribed with antidepressants within 5 years, both men and women are more likely to be prescribed with some type of antidepressant within 5 years as well. So the case for a community model like Falcons Landing, where you have all of these things to do and people to interact with and different levels of care, there's a strong and growing body of evidence that this is one of the best types of options in which to spend your senior years. So I asked my wife, if this meant because all the men were dying earlier, the women were sadder about that. And she told me to get lost and go back to work. So it's been my pleasure to be with you today. I hope that was helpful, just kind of learning what's going on out there. I'd be happy to answer any questions, but I'm grateful for Hardy and Barb for the invitation. Yes, sir. Yeah.
This isn't quite a question. When we all here look at the demographics, we all know that our military backgrounds and all the rest of that is what keeps us going. And that leads me to say that every one of us has got to be marketing for our friends and people we know. And when I saw the presentation before, as you know, and that was the thing that really came across to me, that the demographics that we need, we have to ourselves help get.
My question involves transportation. On some of these campuses similar to ours, has there been any provision in addition to the kind of transportation we provide internally of having a Lyft or a Uber structure on campus for people who are no longer driving?
Yeah, great question. Everybody hear that okay? And what I really said differently, I think you're asking is, has anybody kind of created that themselves versus having to call Uber, the Falcons Uber, if you will? I haven't heard of any examples of that, to tell you the truth. I hear of concierge services where you can call and have a car. And it's not quite, I don't think, what you're talking about, but the short answer is no. That has not really been something that I've seen anywhere.
It should be.
It absolutely should be.
As opposed to voluntary drivers. And
There's a lot of reasons that would be preferred. I agree.
Are there trends in governmental control, either at the federal level, the state, or the local level, in terms of the ability for the management to continue to do its business? Are these government regulations and policies increasing, decreasing, or aren't they even an issue in the management of what we've been talking about? What's the government's role as you see the future?
Right. So couple of thoughts as they come to mind. If you have on one end of the spectrum what I would say a Falcons Landing, which is a private pay, meaning that most of you are paying for your monthly fees or entrance fee out of your own pocket or pension or whatnot, versus Medicare or Medicaid. So that's one end of the spectrum. And then the other are going to be like a lot of government, county-owned nursing facilities that are almost all Medicaid. Very little regulation whatsoever on the Falcons Landings of the world. More and more and more regulation, more inspecting and monitoring, more ranking publicly the nursing homes. At the same time that every year the amount of money that the government is willing to pay per Medicaid patient is going down. So there are many peers to Falcons Landing, let's say, out west that are being built, new campuses today that are being built without nursing. And their plan is going to be to provide more in-home care, or your last place of residence might be assisted living with more support versus a traditional nursing, because of a lot of the regulation that might come across the spectrum over time. So it's mostly in those government payer, Medicare, Medicaid situations. But there are while I mentioned that there are huge barriers to entry to competing with a Falcons Landing, very few of those are related to regulation. It's more just economic and time and so forth. So it's hitting those folks both from a quality management as well as a declining reimbursement. I think you're going to see more and more of those types. It's going to be really, to me it's fascinating, and it's the great question to be solved, is people that can afford to come to a Falcons Landing will continue to come. Who's going to care for everybody else in America that has relied on these nursing homes? And at the time where the government is taking that money away, who knows? That's going to be a great question.
Thank you.
Sure.
I'm interested in the incentive for growth. Is growth to be assumed? And what are the real drivers for expansion? Is there a sweet spot where we can sustain ourselves forever, or is some force going to drive us to expansion?
That's an excellent question. I would say that you are largely at a point of sustainability, or with some of the projects that you're looking at now, going to be at a point where, as long as you don't start subsidizing your operations with the entrance fees, you should be in a position to reinvest the kind of capital. And that's how you've managed this place since day one. And a lot of places, it's like insurance companies that lose money from operations and subsidize their operations with the investment earnings of their premium portfolio. In the long run, that's unsustainable. So with your type of management and the type of entrance fee contracts you have, I would argue that you're in or near that sweet spot right now. It's a very interesting question about the incentive for growth, because you might say, well, if you look at a corporate finance textbook, it's going to tell you more scale generates more economies of scale. And so building systems of communities should operate more efficiently and make them more sustainable in the long run. And so you see that the for-profit side of our sector has adopted a lot of those kind of pretty conventional corporate finance strategies, whereas there are more single campuses in the not-for-profit. Now, they're virtually all doing, are robust with y'all as an example, so why would you merge? But those not-for-profits that are creating systems and gaining a lot of that, it's because their boards have said either we see the business case, we want you to find another location, or we want to spread our mission. And so it might be the local Episcopal retirement community wants to open another campus in the next town. It could be a military group here wants to open up a place in Jacksonville or San Antonio or somewhere in Colorado Springs. And so that drives most of the growth, but there's very little, in my experience, very few organizations where the boards are saying we want to grow. Most of these communities, they're mostly faith-based, and y'all would be an example of this too, are because there was a group of people at some point who said, we saw one of these places somewhere else. We want one where we live. If you think about the founders, they made that observation. They said, we want one of these here. And most of those religiously affiliated ones were, well, we saw one in Charlottesville, Virginia. We want one in Fredericksburg. You don't hear about that very much anymore because most communities have a place like this. So there's without a profit-seeking, carrot at the end of the rainbow, there's not a huge amount of incentive for growth in that sense. What you'll find, though, and I'll end with that, is that until you get to that sweet spot, it's a race against time to get to the sweet spot. Because if you had 100 apartments and cottages, you would not have enough units to really generate the amount of capital you need over the long run. And so these smaller single campuses, probably a lot of the nonprofit mergers are smaller campuses that need to get bigger because they need to invest $10 million in their nursing. They need to redo their dining. They need to redo their common areas. It's not going to generate any new revenue. And so the way you do that is you throw up another 50 units, and you take that margin off of that, and you automatically kind of reinvest it. And so that is kind of where most of the incentive for growth in our sector occurs as people move to that sweet spot, which I would argue y'all are at. Hopefully that helps. All over the place, but that helps.
I guess only because I've been studying your briefing for the last 2 months. There is, though, a government program that does affect us. It's called temporary protective status. And we have 24 employees here that are in that program. We would have lost them in January of this year if the government would not have extended that program for another year. That has to do with the need for a comprehensive integration kind of approach that the government needs to take, but we are caught with those kinds of issues in terms of getting the right employees here at the right cost.
Yeah.
If there are no further questions, thank you all very much for coming.
Yeah. Thank you.